Um, the rules are very simple, actually, but they absolutely, definitely need to be complied with if you don't want to get on the other side of the IRS. And I'm going to tell you, you do not want to get on the other side of the IRS. They have awesome powers. They have more powers than any other creditor, and they can take anything they want from you that you have. And of course, even if the IRS puts a lien against you and comes after you, they still can't take stuff that don't belong to you. And the problem with the IRS is that if you're married and filing jointly, no matter whether the judgment is against the lien will be against both husband and wife. And that is a big problem because there's not much we can do to protect you from the IRS taking your assets if you're filing jointly. Because if you're filing jointly, it doesn't make any difference who made the money, who didn't make the money. The lien is going to be against both of you, which, could make a case for you filing separately, as long as you realize you're going to pay more taxes if you file separately. As I showed you yesterday, the number that you are going to reach as a single taxpayer is $300 and some odd thousand before you have to start paying 37% on every dime you make above that. And once you get involved in the world of real estate, that's not a whole lot of money that you got to make before you're in the 37% bracket. And I hate to see people making a bunch of money. I mean, I can't tell you how many letters we get of people just starting from scratch. And next thing you know, they got more income than they've ever had in their life. In fact, I think you saw one of those here on the video a while ago. That's not uncommon for us to see at all. But if you come from a world where the taxes are taken out of your paycheck, you don't have to think about things like that. But now if you become your own employer, you have to understand that you have to pay these taxes. You have to pay them quarterly. And if you don't, you're going to get penalties. And of course, if you don't pay them at all, you're going to get the IRS on your case. And that's telling you that's one gorilla you do not want to dance with. So regardless of how you own stuff, it is probably likely all at jeopardy because the IRS is not bound to play by the same rules that all your other creditors are. So I'm telling you this because I want you to make a lot more money, but I don't want you to get in trouble with the IRS while you're doing it. So make sure you're very clear on how you pay your taxes. And you don't wait till the end of the year to pay your taxes. Remember, you got to make quarterly deposits based on what you reasonably expect to net. You probably will be advised by your CPA to pay the quarterly taxes based on the net from the quarter that just passed so that you can stay abreast of it and you have a case to make. If you make a whole bunch of money at the end of the year, then you haven't paid your quarterly, then you're going to have some big penalties and taxes. Now, the last quarter, of course, of your year is a chance for you to find out what you're going to make for the entire year. And at that point, if you don't have enough paid in, you can pay it in after the last quarter. But don't forget those quarterly deposits. There's nothing to them. You just got to make a deposit at the bank with the right form that your accountant will give you, and make sure it is very clearly distinguished what year you're paying taxes for, because the IRS gets that mixed up sometimes. And I got to tell you, the IRS of today makes a lot of mistakes. A lot of mistakes. I don't know what's going on up there. A couple months ago, I got a bill for $178,000 worth of payroll taxes for 3 years that are past. I think it was 17, 18, and 19 or something like that. And I didn't know those taxes. So I had to get my CPA to go explain to the IRS why I didn't know those taxes. And I don't know why they said I owed them, but I didn't owe them. And I've had a couple of things. I got another one where they tried to charge me for taxes that were already paid. And it's a good thing I could prove they were paid. So we did. And that's gone now. And they give me a zero balance. But man, I wonder how many people across the United States are getting notices from the IRS. And and just idly pay them without challenging them. And this is why you need a good CPA. Find a CPA that understands the IRS rules. And if you can, find one that used to work for the IRS, because there's a lot of them that did. The more they know about the IRS rules, the better prepared they are to help you when you have to challenge them on something that they did wrong or you think they did wrong. My CPA, in 1 year, saved me $1 million, because I had all those losses from 2008, and I paid. I had a whole lot of losses that killed a lot of my gain. So therefore, I didn't pay much taxes that year. And the next year, the IRS sent me a bill for $1 million because they just imputed it. I don't know how they come up with the number. My accountant got a hold of them and fought it out for about 2 months. And they finally said, no, you got a zero balance. Geez, what would I have done if I didn't have him? He knew more about the IRS rules than the IRS agents knew about it. And frankly, it's not hard to find IRS agents that really aren't that good at what they do yet. So anyway, just get yourself a good CPA. He or she is worth their weight in gold.